Hello, and welcome to the property market update for Queensland from realestate.com.au. I'm Luc Redman. I'm an economist here at REA Group, and I'll be taking you through the property market update today. We're going to start with economic conditions before moving into current housing market, followed by investor activity and the budget changes, with that being quite topical at the moment. And then we're going to move into the outlook and REA's view looking forward. Starting off with economic conditions, inflation's been a pretty key story within the Australian economy for the last 5, 6 years. And that's been the case pretty much since we've come out of the COVID pandemic. What we're looking at here is the Consumer Price Index. The red line is the headline CPI, which is essentially the basket of goods that households consume and the price movement of those. The light blue line is the trim mean, both of which are inflation indicators, but the trim mean essentially takes the top and bottom 15% of goods within the basket and their price movements to essentially get what is called what we refer to as underlying inflation. The RBA prefers to use trim mean when assessing inflation within the economy, and that's purely because it helps remove the volatility that we kind of see within the headline CPI. So, as you can see when you're looking at this graph right now, the red line tends to grow more than when inflation is rising really quickly, the red line tends to be higher than the blue, and when it's declining very quickly, it tends to be lower than the blue. So it tends to have a bit more volatility than what we see in the trim mean. And the trim mean just kind of tries to remove a lot of the noise so that the RBA can understand what's going on with inflation within the economy. When you consider inflation, um, currently, we're in a relatively high inflationary environment still, and it's still expected to rise to some extent. When you look at the forecast from the RBA, which is that dashed line, the dashed light blue and the dashed red line, which came out with one of their most recent statement of monetary policies when they make the decision about what they're going to do with interest rates, they're basically not they're forecasting inflation to return to the target band, that 2 to 3% range, that grey box that you see on the screen, within in about mid 2027 for underline and headline a little bit earlier than that. We've The problem has been that inflation has remained quite sticky within the economy. So the light blue line only just came into the target band at some point when we kind of saw a bit of cutting of interest rates. And when that cutting occurred, essentially we saw quite a big uptick in inflationary pressures to the point where we are now, where they are quite elevated and concerning for the economy at large and the RBA. The main reason why we've seen inflation kind of not go away is mostly because of domestic factors. So when we consider what the basket of goods is made out of, what inflation is kind of made from, there's kind of two main components. The big one that we kind of see, which is two-thirds of the basket, is non-tradables. Non-tradables is essentially domestically driven inflation within the economy. So that's things like electricity, rent, pharmaceuticals, hairdressing, all of these things that households can kind of consume, but they're determined by domestic prices. The light blue line that you see here, tradables, which is essentially internationally competitive prices and international markets that determine the prices, that's been a lot lower than what we've seen domestic inflation being. So when we came into 2025, both of these were quite low, or the non-tradables, domestic inflation, the red line was about to touch the target band, and the RBA had some confidence that it would return, which it did very marginally for a brief period. They cut interest rates, and we started to see demand return, particularly domestically. The thing that really worked against that domestic rise, which we've seen an increase of up to 5%, was that tradables, the internationally competitive prices, also grew to around 2% and has since had a large spike because of the Iran war. Essentially, what this kind of means is we've still got quite a strong inflationary problem within Australia, And that's mostly due to domestic factors over what's happening in the war in the Middle East at this point in time. And you can see that we've had a bit of a drop back down since there's been policy in the light blue line, since there's been policy responses to higher oil prices. So the halving of the excise, free public transport, those sorts of things that have helped put downward pressure on price growth, as well as a slowing or sorry, a lowering of the oil price. Ultimately, though, it doesn't really resolve the problem at hand. That red line that still hasn't quite moved back in the direction that the RBA would like to see, and that's going to be their main priority moving forward. Ultimately, because of that, they've had to raise rates. Rates have essentially meant have leveled a recent high, and what we're currently looking at here is mortgage rates. So for new owner-occupier variable rates. Obviously, this rate can be different depending on the person purchasing, the amount of loan to value ratio, and other factors. But ultimately, it sits at about 6.23% for a new owner occupier. And that's kind of broad across the Australian financial market at the moment. That's about the average. In terms of recent history, it's about the equal highest that we've seen. And that's more to create a contractionary stance by the RBA to essentially slow demand within the economy, increase the cost of borrowing, and thereby making people pull back in decisions. And when you consider this in a longer time series, it's about the equal highest since 2011, 2012. And that's coming out of what was the GFC. And we've seen quite a large cutting of interest rates ever since then until about 2022. They were either held or they were cut. And that spurred a lot of price growth and investment within the economy. And we kind of overstretched that, sorry, coming out of the pandemic. Unemployment. So what we're looking at here is the unemployment rate of the Australian economy going back to the 1970s. So when inflation rises, unemployment tends to fall. When unemployment rises, inflation tends to fall. They have an inverse relationship that's been shown in empirical economics, and they tend to continue along that general line. When we had the high inflationary environment coming out of the pandemic, we had quite low unemployment. Right now, it's still relatively low, but we still have quite a high inflationary problem. So what we're seeing here is, by historical standards, that red line, we're pretty close to still being at historical lows for the unemployment rate, which the Reserve Bank is trying to maintain in terms of the way that they're going about interest rates. But having that historically low unemployment rate has meant that wages have grown relatively fast compared to what we've kind of seen recently in recent history. The WPI, wage price index, has grown quite strongly, and that's because there's been quite a tighter labour market, which has eased of recent times. But ultimately, those wages grew, but they didn't grow by enough to out run the inflationary problem. If we're looking at the little blue line here, that's kind of the RBA's forecast for the unemployment rate, where they're increasing interest rates or holding interest rates higher to slow demand in the economy, to bring inflation back to the target band, as they expect in the dashed line that you would have seen before. And that essentially means that unemployment's going to rise because of that inverse relationship. Even though it's still going to be at a very low level, and at a level that we kind of, in the pre-pandemic times, in the 2010s, we are still quite below that mark. Those stronger wages have, in some part, helped the economy. So what we're looking at here is GDP growth and contributions. Those stronger wages have helped strengthen the economy in some ways. Ultimately, it's actually been a fair bit more of data center investment in recent times, but slightly prior to that, it's been a lot of public investment and public consumption within the economy that's kind of driven GDP growth. So GDP, gross domestic product, it's kind of the preferred measure of how an economy is going and an economy's growth is and its output. And what we're looking at here is the national GDP. So The black line is the annual price movement of GDP within the Australian economy. And essentially, at each quarter, we see the contributions to that annual growth. So, looking at each of these bars, we kind of have in red net exports and others, in light blue private, in purple public. So, those are the areas of the economy that have contributed to the growth in GDP. And what we see is there was quite a big spike in the middle here, a big fluctuation from the pandemic when the shock occurred, and we had a policy response and we all came out of it. The private sector drove a lot of that growth, mostly because of very favorable settings from policy responses, be that low interest rates, a lot of things like job keeper, those sorts of policies that kind of responded to the economic shock. They drove a lot of private sector demand and growth. And essentially, when the RBA had to start hiking interest rates to control the inflation problem because of that excess demand, that essentially pulled back the private sector growth, as you see, into about 2020, into 2020, late 2023, into mid to late 2024, 25. Ultimately, until that point, the only thing that was really keeping the GDP and the economy growing was public sector demand, which is essentially government spending in the economy, with net exports and others actually declining slightly, and only a marginal amount of private sector demand. In the last few quarters, what we've actually seen is like a quite a strong return from the private sector to the GDP growth, and that's mostly been because of the demand for data centers and data center investment within Australia. That's been driving a lot of capital into the country, and in turn has been pushing the private sector where to a point where we've actually had some relatively strong growth within the private sector recently. Now turning to population and focusing a bit more on the state level, the population in Queensland has grown dramatically in recent times. It's outpacing the national average at least since 2018. And that's kind of been the case pretty consistently across each quarter. When we look at the left graph here, we see the red line, which is Queensland's annual population growth, currently sits at 1.6%, slightly above Australia's 1.5% on average. And we saw, like everywhere else, quite a big drop off during COVID, but that was ultimately only really due to net overseas migration, with actually quite a strong demand returning to from net interstate migration and consistent natural increase occurring within the region. Queensland, looking at the chart on the right, the contributions and the components of population growth have never really been negative, except for any component has never really been negative, except for during COVID, when there was quite a big exodus for net overseas migration, but that's returned quite dramatically to Queensland, as well as quite a strong inflow of net interstate migrants. So we haven't really seen levels like this into Queensland in terms of net interstate migrants since about the early 2000s, but in recent history, not really at all. Natural increase, which is essentially the number of deaths minus the number of births minus the number of deaths, has been relatively consistent, albeit slowing and a little bit. But that's pretty consistent across the whole Australian economy as we have an aging population. Moving over to house prices and the established market, Queensland property prices have more than doubled in the 6 years since March 2020. They've slowed down quite a bit in the last 6 months, and that's kind of been pretty consistent across most markets in Australia, thanks to higher interest rates and changes in tax policy. But ultimately, Brisbane and the rest of Queensland have far exceeded the national growth in property prices over that period. They currently sit, both of those regions currently sit about just shy of where Perth has sat over that same period, where Perth has experienced very similar migration trends and demand as Brisbane, as people have moved interstate to chase those lifestyle factors that those regions have, as well as quite well-paying jobs relative to regional areas. looking at types of units and property types and how units have outperformed houses. Essentially, in Brisbane and for a lot of the rest of Queensland, we've seen units actually grow in price a lot more since 2020 than houses, which is a bit backwards compared to what we see nationally and has historically been the case. And that's mostly an affordability driver. So when there's been expansion of the 5% federal deposit scheme, um, essentially that's drove a lot of demand at the lower end of the market. There's a lot more supply available at the lower end of the market, which are units. And the ability for people to bid up prices at that lower end has been quite strong. So we've actually seen quite more elevated price growth in units in Brisbane than what we have seen in houses. And that's relatively true for the rest of Queensland as well, as that affordability kind of bites. Whereas when you look at the blue line here across these two graphs, the national houses has actually outgrown the national units, and that's kind of been consistent for quite some time over the long run. But the interesting takeaway is that Brisbane, Queensland, we're starting to see more price growth or have seen more price growth, particularly in the last 12 to 18 months in units over houses. And we really see this come to head when you look at how the change in home prices by price tier looks. So we're essentially looking at Brisbane here from a similar timeline. You have the low in the red line, the mid in the blue, and in the purple, the high. And that's essentially the price growth of those sectors of the market and how they've fared over time. So coming into COVID and coming out of COVID until mid to late 2022, you essentially saw higher price growth in the higher medium area of the market. And that was partly because Brisbane was a little bit more affordable than markets like like Melbourne or Sydney and those larger markets where it was a little bit more affordable and there was quite a lot of interstate migration from those markets to Brisbane. So the ability for people to sell here, make a gain, so in Melbourne or Sydney, and then make a gain and then move from Melbourne or Sydney to or New South Wales or Victoria to Brisbane or Queensland and purchase a property at a cheaper rate but at a higher level than at a more premium level, essentially bid up prices to that point. Then what we saw was the low growth area, kind of accelerate coming out of that. So the demand remained quite elevated. The affordability began to bite. People started substituting the property type a lot more from houses towards units because one, because they couldn't necessarily compete on the price point, and two, because the potential availability of units versus houses in places where people want to live versus having to potentially purchase a property type in somewhere else was. We see this particularly when you look at prices by price tier. So looking at this graph, this is prices growth by price tier. So low being the red, medium being the middle being the light blue, and the high being the purple for Brisbane since March 2020. And what we really see is the higher price tier growth being quite strong during and coming out of the pandemic initially, as you saw a lot of interstate migrants move from Sydney, Melbourne, and those areas towards to Brisbane and southeast Queensland, for chasing that lifestyle with higher wages and also potentially realizing a property sale in those markets that allowed them to purchase at a greater price point in Brisbane initially. Coming out of that, we saw the lower end of the market grow a lot more strongly than the higher as it plateaued as interest rates increased and people started substituting the relative property type for more affordable options like units and those sorts of things and bidding up those prices. We particularly see this when in October 2025 when the 5% deposit scheme got expanded and there was a bit more of a boost in that lower end of the market, which we've kind of see right now as plateauing a bit, which is something that would have been seen on the ground by real estate agents as to what buyers are currently wanting and sellers are wanting to sell for. And we do see a little bit of a dip here, not too dissimilar to the start of what happened when interest rates were going up in 2022 on this graph. And it's important to take that in the picture of the broader price growth within the region that has more than doubled over the 6 years and is still on a relatively strong long-term trajectory due to undersupply of dwellings within Brisbane, Southeast Queensland, and broader Queensland. Noting that um, a lot of properties right now are potentially selling below the asking price, and there's been quite a big uptick in that. So what we have here is a time series on the left and right for Queensland on the left and on the right for national of the number of properties that have sold below the original asking price. So looking at the Queensland one, prior to 2020, there was quite a high proportion between 70 and 80% that would sell below the asking price within the region, within the state. That dropped dramatically during 2022 into 2022, and essentially it came up again when interest rates started hiking and has gradually trended downwards to roughly where we are now, even though there's been quite a big spike in recent times with a lot of tax changes and interest rates um, increases. But ultimately, taking a longer run view, considering Queensland on the left, where we have the dotted line, which is essentially the long run average of this whole time series, we're still quite a fair bit below that long run average. That doesn't necessarily mean that properties are selling more or selling less, but that actually means that those ones that are selling are still kind of selling pretty close to the price point that sellers want. Similarly, that's still the same at the national level, and it's been down a fair bit since what the long-term average is and what it used to be prior to COVID. So that's something to take into a fair bit of context in terms of where the market's at. It may be that this will continue until interest rates come down and we start seeing a bit more demand return to the market. But ultimately, buyers are currently in the position where they can wait and see a fair bit. And that might mean that if a seller is trying to get to sell a property with some urgency, then they may be having to make a lot more concessions. Looking at rentals now, rental availability is something that is covered quite extensively in the media, and it's still quite a big problem nationwide. So looking at the rest of Queensland and Brisbane on the left here versus regional areas and capital cities on the right, we essentially see that we are still at quite a low level. So anything below 2% is considered high rental stress, and we've been pretty well below that as a nation since about 2021, and that has been maintained quite consistently. And whilst seasonally we tend to see a little bit of an increase in the vacancy rate about mid-year, there's actually been in some markets and a bit more strength in that increase in the vacancy rate over the last couple months. Rest of Queensland has grown quite strongly to the highest point that it's been since 2020. Brisbane's still a bit below that as currently, but there's quite a lot of capital works happening in those areas. It's also a slight improvement than what we kind of have seen. In capital cities and regional areas, there's been quite a big improvement since the start of the year. And it remains to be seen over the next couple of months how that the investor impacts are going to affect these vacancy rates. Those really low vacancy rates have helped contribute to quite high um, growth, quite high rental prices and quite strong growth, particularly since when you consider Brisbane and the rest of Queensland was below the capital cities prior to COVID in terms of asking rents, whereas now they're actually both about equal with capital cities. They far exceed what regional areas are asking for, and they've kind of moved in pretty lockstep since about 2020. And that's partly because of the broader area of southeast Queensland being majority of regional Queensland, of rest of Queensland within this data. But ultimately, the fact that it's aligned with the rest of the capital cities, these larger markets like Melbourne and Sydney, which take up about over half of the capital cities' weight, essentially Brisbane and rest of Queensland's becoming a lot more unaffordable than these larger markets. Looking at listings activity, it's trended quite strongly in recent times. So what we've kind of got here is the Brisbane new property listings by month through to June. And essentially, when you look at the 2016-2024 average, the purple line, it's quite a fair bit above that right now. So 2025 was relatively strong for new listings with a bit of a drop off in November and December, but we usually see a bit of a drop off in new listings at that time. Ultimately, right now in 2026, we've seen more new listings come online since really about March, as the first kind of couple of interest rate hikes started, and they still kind of remain pretty elevated. The factors that are contributing to that aren't necessarily clear, but one of the key drivers has been um, investors looking to sell, and that's been because of budgetary changes and cost of capital. So when we look at the shifts in government policy, which has led to current market that we're in today, plus interest rates. Essentially, the government policy shifts will mean that we're going to see a lot higher proportion of owner-occupier sales over the short term. So those sales that are occurring are more likely to be an owner-occupier, whether that be a first home buyer or someone downsizing or someone purchasing, like upgrading. But looking at the budgetary changes, the two key ones being the capital gains tax and negative gearing. So the capital gains tax will essentially use a different discount methodology, which is reverting back to the old model that used to exist which will exist in financial 2028. That'll be combined with a minimum marginal tax rate of 30%. And that's the aim of that is to essentially stop strategic realization of gains, of capital gains, which doesn't tend to happen as much in property, but certainly does in shares and business ownership. The transition will kind of occur on the 1st of July, which is the start of that financial year 28. And any unrealized gains there will be either assessed at value by a valuer in the period just before, which will essentially say the proportion of that property's value from is subject to the 50% discount, which is or and any future value gain on top of that will be at the indexation rate, or you can claim it as a pro rata of a share of holding time. So if someone come July 1 has held a property for 5 years and essentially 2 years after the fact into the indexation method, they decide to sell it, they can pro rata that, 5 years of that will be under the 50% and 2 years will be under the indexation. New builds can choose between either of the two discount methods. So that's really on them to see which is more favorable in terms of tax treatment. And principal place of residence is still CGT exempt. Negative gearing has shifted from deducting losses from current income to deducting losses against future property income gains for established property. And that's essentially means that you can, across a portfolio or across the property, if it's going to be positively geared into the future, you can use those positively geared income in the future to offset the loss, any sort of losses that occurred in the past, and until it balances out, and then you'll be taxed on the net income gain from there. Commercial property and new builds can still access the old negative gearing rules, and purchasers prior to budget night are still able to claim negative gearing into the future, which will either be they sell or they will become positively geared at some point. Additionally to this, there's been the anti-money laundering, the AUSTRAC anti-money laundering regulation, which I'm sure you're all across, but is essentially a way that real estate agents need to verify clients and assess the financial means as to how they access that money to help prevent money laundering. Looking at the CGT discount, very briefly here, what you're essentially looking at on screen is for residential property investors, how under each of the discount methods, they would have fared in terms of having a lower capital gain tax bill under each of the two methods over since about 2015, since about 2014. So when you look at this graph, it's actually not as arbitrary as some of the commentary has been around the CGT, particularly for residential property investors. Obviously, the type of asset matters a lot and how much of a gain it has accrued. But we've kind of seen, somewhere between 50 to 25% of properties in Brisbane actually have a more favorable tax bill under an indexation discount method than a 50% discount method. That means the majority are still under more of a benefit under the 50% discount, but it means it's a very different discount method to capital gains than what we kind of have seen. Um, then as it's not as arbitrary as it kind of can seem. Investor activity, that's remained quite strong within Queensland. So this is new investor loans within Queensland. And until March, it was still quite strong after and continued to be grow since the start of 2023 after the initial part of the cash rate hikes. And what we may have seen is potentially a topping out of that for at least the next short while as prices reset and yields may potentially be revalued for investors before they enter back into the market. And what we kind of see here is that has been a big part of the Queensland market over the last 6 years, where we've seen a lot of first home buyers coming in, a lot of interstate migrants coming in, and we're also seeing a lot of investors buying. That's essentially meant that there's actually a lot of investors selling. So even a little bit prior to budget night, we started seeing a bit more growth in the investor listings for sale, and which was similar to the peak that we saw in 2021, in mid 2021. Brisbane compared to the rest of Australia. So what we're kind of looking at here is investor share of new listings, for sale listings on REA. And Brisbane's accelerated quite dramatically along with the rest of Australia ever since the budget night. But ultimately, that means that there's still going to be quite a high proportion of investors that are looking to sell over the short term, potentially looking to sell over the short term, and an opportunity there for agents to get those listings at least over the next little while. Looking forward, we're still not really building enough houses. So when you consider all of these tax changes and policy interventions that are coming from the federal government, they ultimately don't really address the problem at hand. And the problem is that we don't have enough supply. So even when we consider the National Cabinet's target of 1.2 million homes over 5 years, we're not even close to that mark in terms of dwelling completions. So looking at the left, we have Australia and the units and houses completed. It's pretty well a third below where it should be at this current point in time. And similarly is the same in Queensland, where we're still about a quarter to a third below what it should be. And that doesn't look like there's been any sign in recent times that it'll actually catch up to that, which means we're going to see a lot more excess demand for dwellings than we will see supply. And that only means that prices will continue to rise. Having a look at the cash rate now, economists kind of disagree on the cash rate and where it should go from an RBA perspective here. Inflation data is essentially going to tell us who's going to be right. So what we're looking at here is the cash rate is in red, the historical cash rate, and we've got three forecasts in the dash line. So the green is Westpac. They've essentially got a peak and an offset. And then the purple is the market economists one, where they survey market economists. And then the light blue is essentially the RBA's statement of monetary policy. So that those three forecasts kind of move in different ways. Westpac is saying that they still believe that there'll be 1 to 2 more hikes. The statement of monetary policy in the light blue is essentially saying that they still reckon there will be one or so hikes, and market economists are saying that they're going to leave it flat for the least next little while before it begins to contract and increase and then be cut. Looking forward, particularly looking at Brisbane, we still think there's going to be pretty strong price growth into 27, albeit a lot slower than what has recently been the case. And we currently expect that to kind of continue for most markets. Thank you for joining us and hope this was informative.